Hello and welcome to Weekend Investing Daily Bytes. Two announcements before we get into the daily bite. One is we are holding a stairs webinar on Saturday, 7th January at 11 a.m. It will be a brief introduction to the stairs models that we run, the calendar year 22 performance, and how allocation to stairs can be helpful in a volatile year like we've seen in 2022 and possibly in 2023. And we'll also have a live Q&A session there. You can join the stairs free telegram and use the link in the description below and send us queries ahead of the webinar. For those who don't know about stairs is a long short strategy on Nifty. It trades four models on futures and options. Some are options buying models, some are option spread models. One is a futures model. It is extremely different from all other weekend investing products in the sense that it's a derivative strategy and hence it entails high risk on capital. But if you are interested, please do come to the webinar and do seek more details. Sm- the loyalty program that we launched 6 days back from 1st of January, called Wild Weekend Investing Loyalty Discounts. This is one of its kind loyalty program run by any small case manager. We are the first ones to do this. If you have spent more than a year with any weekend investing strategy, this becomes applicable to you. Uh, when you are renewing your strategy next time, just click on this apply offer uh, tab in the small case app, and these discounts will automatically get applied to you. So if you have been into that strategy for a year, you'll get this discount. If you have been in the strategy for 2 years, you'll get this discount. For 3 years or more, it will be this discount. In case that discount is not automatically applying, you can feed in this discount also. You can type it in with the month, the year, wild, and the amount of the discount. If you have any issues with this, not going through, please do send us a mail. We'll help you out. But I want you to know that this is available to you if you have been with the weekend investing strategy for 1 year or more on the annual plan. And also a very big feature of this wild program, which many of the people who have used it so far are missing, is that it allows you to add on a new strategy with the same discount code also. So if you've been, let's say, with all cap and now you want to add on mi20, then you can use the same code on mi20 for the next 30 days. So this is something that I wanted to clarify. Now, coming back to the weekend investing daily bite episode, we are doing episode number 328 today. Why are central banks buying gold? We've seen a lot of reports that keep coming that central banks continue to buy gold. Have you ever thought about why should a central bank buy gold? I mean, if gold is such a useless piece of rock, why should central banks hold gold? Why should they hold it? Why is they are not holding silver? Why they are not holding platinum? Why they don't have a reserve of steel or crude oil or any other commodity? But why gold? Why is US holding on to 8,000 tons of gold? Why is China holding on to an undisclosed more than 10,000 tons of gold? Why is India having 600-700 tons of gold? Please do think about this. Why central banks hold gold, and you'll get some answers once you start to research this. Coming to the market for the day, the market was a dismal market today. Started on a weak note and stayed weak for most of the day. Recovered slightly towards the end, but nevertheless a 0.7% loss for the day for the Nifty. IT stocks leading the market down. So Nasdaq was down yesterday, and I am, like I said yesterday also, there is a feeling that IT results will not be very, good looking in terms of their forecasts. And the first, I think, result from Infosys is due on 12th of January. So some of that is already getting priced in into the market. But besides IT, I mean, banking also was dropping hard. There were some rumors that a big block of Kotak Bank is going to get traded, change hands at -5 or -10% from the market price, and that is also causing some distress there. You can see that banks, metals, pharma, everything was dropping today. Even FMCG was the only one with along with energy that didn't drop. Although Dabur announced a weakening of margins going forward, and that stock dropped quite massively today. So the market doesn't seem very bullish right now, but I think that turn will come in the next week or 10 days, where everything else will get forgotten, and the budget hopes will start to weigh over everything else. That turn should come maybe by the end of next week or so. I'm expecting that. But the global markets remain in a conundrum. Nasdaq, S&P 500, all dropping. Tesla, Amazon, Facebook, you name the stock, and they are near their 52-week lows. So no respite from overseas market on that front, and no respite from FIIs selling down our market. So, I mean, that component of the liquidity flow has been very, very negative. All indices very much in unison today. Everything was down about three quarters of a percent. In terms of weekend investing performances, also a lot of them were down about three quarters of a percent, but some were more. So MI 35 was 0.8%, MI Evergreen was 0.9% down, and NF10 was 1% down, MI 30 was 1.2% down, MI 20 1.35, MI 80H2 1.4% down. Uh, Nothing more to say on this. It has been a bad 10 days or so. After that, market hit 17,800. Market has nicely bounced, but that has all been given up. So now we are at a very crucial, again, 17,800 level, where if that breaks down, then of course we are going much much lower maybe. But this, if it holds, then it becomes a double bottom, and then we may bounce off from there. Today's heat map, you can see there's heat all over the place. There's virtually no green. Britannia was up 1%. uh, I'm having Reliance was up 0.9%, but a lot of red here. Tech Mahindra, TCS, Infosys, HCL Tech, Wipro, State Bank, ICICI Bank, HDFC, Kotak, Bajaj Finance, Bajaj Finserv, all down. IndusInd Bank down. JSW Steel down 3%. So, pretty much a very weak sort of a scenario. But within that weakness, some top gainers. IDBI Bank up 8%, Radico Khaitan up 6%, Rajesh Exports nearly 5.5% up. KPIT Tech has been very, very unique IT stock that has diverse diverged from the IT pack and was up 5%. Godrej Industries, there was news on this, up 5%. In terms of losers, insurance stocks losing big. General Insurance down 7.5%. New India Insurance down 5.5%. Fertilizer and chemical has been going circuit to circuit, up and down, -5% today. CCL Products down 4%, and Birla Corp also losing about 4%. So they talk about central banks buying gold. This is a nearly a 15-year chart on worldwide central banks' quarterly gold purchases in tons. So you can see from the very start that after the 2008 GFC, Great Financial Crisis, central banks have been buying some gold. Maybe from 2009 onwards, some amount of gold they've been buying, whether it was 100 tons, 200 tons, uh, slightly less in 2018 to 2020, and then more after COVID, then a bit less after that. But now in Q3 of 2022, uh, the total gold purchased by central banks worldwide in January to September 2022 was 670 tons, and 400 tons in Q3 alone. So this pace of sudden increase of purchases by central banks is something that has not been seen since 1960s. And all this data is sourced from the Economist, but Nikhil Kamath had posted it very nice tweet yesterday, so I'm using the data from there. I believe uh, I've been pushing people to buy gold and have asset allocation in gold for a long time, but people don't listen to me. But a big voice like Nitin Kamath probably can also help. So I'm glad that large fund managers who have a lot of following and hold over investors' thought process are also advocating sane advice on asset allocation and gold in particular. So that is a very healthy and nice change that I'm seeing in terms of the average fund manager not being so cued in about gold. In fact, most of the financial analysts are very much against the idea of investing in gold, because we have been brainwashed since last 40 years by the financial uh, gurus that gold is zero yield, so why buy it, and it's a useless piece of rock. But the useless piece of rock has been doing quite well, actually. So which countries have bought the most gold in the previous years? Turkey has bought a 94 tons of gold, uh, January to September 22. So just in 9 months, they bought 94 tons. Egypt 44 tons. Iraq 33 tons. India has done 31 tons. I think 31 tons is about 4 to 5% of their existing holding. So, which is not a small amount. I mean, if you increase your gold holding by 4 to 5% in 9 months, that's pretty large. Qatar did 30 tons, Uzbekistan did 28 tons, and a lot of countries like Russia, China, uh, many other countries are not even disclosing what they're buying. So, in terms of their holdings going up, uh, could be several times higher than what is the official number uh, out there. And one in every four central banks has plans to buy gold in 2023. So this is the reason that is being given out in terms of a survey done by World Gold Council, why central banks are buying gold, is that there's a risk of a global financial crisis. 78% banks think like that. So central banks, with all their resources, with all the planning, with all the forecasting tools that they have, 78% of them are saying that there is a global financial crisis coming, and there's a good risk of that, and 78% think that way. So you can imagine that we are not sitting in a fairyland right now in terms of the economic makeup of the world today. Changes in global monetary policies. 57% want to hold on to gold because they may be feeling that over at least this decade, at some point or over a period of time, there will be some change in terms of which is the reserve currency that we will go forward with, how the global trade will get traded in which all currencies, not just in the US dollar like it is right now. Economic risks in the US in particular. So what happens if there is some concentrated economic risk in the US and the dollar takes a beating? In that case, gold will do very, very well. 57% think that is the reason to buy gold. 50%, of course, are holding it as a inflation protection. 50% of central bankers. And gold as a hedge to the currency itself. 50% is the reason for that. So these are all the reasons why even you should be looking at gold for your own portfolio. I mean, central banks are doing it on an institutional level for the country, but the same dynamics applies to you as an individual, as a portfolio holder also. I mean, if there's a risk of global financial crisis, your portfolio gets hits. If there's a global monetary policy change, your portfolio gets hits. If there's an economic risk in US dollar, you will get hit. If there's a rising inflation, you are getting it. If you have some hedge, you will get protected. So exactly the same reasons why central banks buy gold, you should be buying gold. And of course, India is buying too. So India is buying to diversify its forex reserves because India holds some huge amount of dollars in its reserve, and it always wants that, at least 10% of that should be in non-dollar format in terms of gold. And you can see that the gradual accumulation is increasing the gold component that India has as a total forex reserves. And I think they plan to take it to 10% very, very soon. So having some exposure to gold can be very, very beneficial during weak market situations, especially. And weak market does not really mean a cyclical weak market. It could be a structurally weak market at some point of time, also, like many other countries have seen. And we have this MI Evergreen portfolio exactly for that reason, that you can combine the best of CNX 200 stocks along with the protection of gold, and that makes it a very complete core portfolio. So if we just see how it has performed since we went live June 22, you can see that this portfolio is up 34% versus 18% on the index. Sorry, since June 22 was that, and we went live in December 21. So it's a plus 17% versus 5% on the index here. And the magic of gold, I've gone through these slides many times before, that whenever you will find weakness in the market, gold will be doing well. Weakness in the market, gold doing well. Weakness in the market, gold doing well. So the idea is that we outperform when markets go up, and we outperform when markets go down. When these two are combining, you get the magic that we have here. And for Evergreen, we have a New Year 30 code that is currently running. This is running till 10th of January. So please use that if you wish to get into this kind of a strategy. So with this, I mean, if you have not yet invested in gold, you're still confused about it. I would think that you've not really paid attention to so many daily bites and so many tweets about gold that we've done. Please do some research on this. This is for your own benefit. I have no axe to grind in terms whether you buy gold or not, but please do a research on why gold is a fantastic insurance, fantastic hedge for your portfolio. And I've shown you n number of reasons why you can't really deny that fact, that it is actually going to help you if there is a currency crisis, if there is a government crisis. Right now we are sitting in a very nice place. We have a very stable government, very strong leadership. Rupee is also reasonably okay. We have a growing economy, but this need not be there every time, that in every situation. 10 years later, maybe this is not the situation. 5 years later, maybe this is not the situation. So you need to plan ahead. I mean, once the crisis happens, then if you start thinking about it, nothing can happen at that time. So the insurance and the hedge is always a plan. Why do you buy life insurance? Why do you buy car insurance? uh, why do you buy health insurance? I mean, you don't want to get sick, right? You don't want to die, but you do that because just in case things uh, you know hit the fan, you need to have that protection for you, yourself, and your family. Thank you so much. I'll see you in another video. Bye.